Good afternoon. Welcome to the second episode of Bayut Real Estate Bytes by Mahmoud AL Burai, a program that is fully dedicated to raising awareness in the real estate market, answering stakeholders' concerns and issues. Our first episode was watched by more than 200,000 people, which was a great success. We're looking forward to your engagement in today's episode that is going to be live on Facebook and Instagram. I have today with me distinguished experts from Dubai real estate markets: Plumb, Head of Research at JLL; Shahram Safai, Partner and Head of Real Estate at Afridi and Angell; Stuart is the Head of Mortgage at Allsopp and Allsopp; Andrew Love is the Head of Investment and Commercial Agency at Cavendish, Maxwell. Great to have you today, and I will start with the questions, so we can accommodate all the questions we received today. Feel free to send your questions, and we'll be trying our best to answer them. So the first question, Craig, how is the real estate market doing now, where we are at this point of time?
Thanks, Mahmoud, and it's a pleasure to be here. I think we have to say that we're getting close to the bottom of the current cycle. Whether you look at residential real estate or commercial real estate, all the indicators have been a negative for the last 3 to 4 years. And we'll talk about the reasons for that as we go on to this discussion. We think now we're approaching the bottom of the cycle, which makes it a great time to be thinking about potentially investing in Dubai. Just for a couple of numbers, basically the residential market is the most tracked and the one with the most data, and prices have come off, and rents have come off between 25 and 30% since the market peaked back in 2014. So it's not been a dramatic fall as it was in 2009, 2010, but it's been a prolonged fall over 3-4 years, and we're getting close to the bottom in our view now.
Great. Andrew, if we want to follow up on, Craig talked about the residential. If we go to the commercial side, how is the commercial side doing? What are the positive and negative trends that we see in the market?
Yeah, I think similar to residential, we've probably had a 3 to 4 year sort of price decline. I think we're a wee bit, was a little bit slower at first than residential. So we saw residential fall first, and then about 12 months later, commercial then started dropping off. And we've probably seen in some areas 30 to 40%. Positive side to that is some of the levels of transaction that we are seeing now and offers being made. Fantastic time for buyers and renters. I honestly can't believe some of the deals that some of them are getting. So it's good for new businesses coming into the country and setting up, and it's good for existing businesses who are looking to do lease renewals on their office space or upsize and look at taking better space. They can get more flexible incentives, whether it's rent-free. If you're a retailer, you can negotiate capital expenditures, so basically fit-out allowances. So on the plus side, it's a pretty good time to be in the market for a buyer or a renter.
Do you agree, Craig, that the market is affordable now for people to come and jump in and invest? Or still we need to wait or hold? And a lot of investors actually are taking the side of let's hold and wait.
Well, of course, you can never totally predict the bottom. If we could do that, we'd all be very rich. And it's better to be going in slightly before the bottom than it is slightly after, because, as Andrew just said, you can negotiate a very good deal at the moment. Once the market has turned and that sentiment starts to come back, things will move more quickly, landlords will be less flexible. So I'd say now is a good time to be looking. JLL's view is that residential and commercial prices will probably soften another 5 or 10% from where we are, but you can never get the total bottom of the market. So we'd say now is the right time to be looking.
I agree with that. I always say to the businesses we meet, you're here for the long run, you're not here for the short run. So whilst it might drop 5-10%, maybe even 15%, don't try and time the bottom, because you will miss the bottom. If it's the right decision for you to move or to set up your business, then do it. But I don't think it's a bad time for sure. It's good.
Mm-hmm. Dr. Shahram, you've been following with Dubai real estate regulations and laws for the last maybe 10-15 years.
Yes.
How do you see the current regulatory framework and the current regulations in Dubai? Are they fully protective of stakeholders? Are we there yet? We still need more?
Well, we've come a long way since the early days of the early 2000s, when property was being sold with very little regulation. And a lot of the sales that occurred back then were based on contract and based on affirmations, oral, verbal. Then in 2006, we had the first law that said that foreigners could own property, freehold in Dubai. Thereafter, in 2007, we had the escrow account law, which protected buyers who were buying off plan. Their money was protected in a special bank account. And then the interim registration law, Okud, and various other laws over the years. In addition to the laws that we have, which are based on international best practices, we also have RERA and the Land Department, which avidly are involved in protecting buyers' interests, protecting investors' interests. So we really have come a long way. We've matured. Of course, there's always room for growth, always room for improvement, and I think all the market participants are working towards that.
We will come to the question on how should investors behave when they get into any transaction, what they should do, what they shouldn't do, and all the do and not to do.
Yes.
But this is a question to come later. Today's episode is focusing on investment and mortgage, and we have today Stuart, who is leading the mortgage in Allsopp and Allsopp. And a question on mortgage: how is the mortgage market doing right now? We're saying that prices are affordable, so people who have money maybe can invest, but those who need mortgage and financing, what they should do?
Okay, I mean, the mortgage market at the moment, for me, is probably the best it's ever been, in as much that there's way more products available in the market. From when I came here a long time ago, it was very much a vanilla service that banks were offering as one bank, one product. You've now got a variety of products offered by different banks. It's way more competitive than it used to be. The margins that they've got attributed to variable rates have come down so far that they're probably a fifth of what they were when I first moved here back in 2006. I mean, you get margins now of 1.5%, which is similar to what we see in the rest of the world. And if we look at it in terms of the fixed products that they're offering, they've got up to 5-year fixed. They've got 2 years at a very good rate, 3 years at a very good rate. So it's very competitive and affordable on that side. It's more still a case of you've got the restriction where you have to put in at least 25% deposit. So some people still struggle with this point, and then you get your fees on top. But there are products expanding as well that can accommodate these fees to be added within the mortgage, or there's like secondary loans that they can take to take the fees on as well. So it's becoming a much more affordable prospect for people to get into buying property. And when they look at it and say, okay, well, I can save for another 2 years, but I still have to pay my rent, or I can take this affordable loan that's part of the product, and then I can buy the house and then pay my mortgage for the next 2 years. For me, it seems to be, it's a better prospect. Banks are becoming more creative to get into that.
Very good. The question now that a lot of people have now with Dubai real estate market now giving a lot of incentives, especially by developers, and they have to choose, and as an expert in this field, what do you think? I have two options. To take the developers, especially for the off-plan we're talking about, to take the developers' flexible payment plans, 5 and 7, and even some cases it goes up to 20 years, or go to the mortgage side, and what are the costs and benefits of each?
I mean, from what I've seen, there's a lot of post-handover payment plans with developers, but you could probably buy the same property in the market for about 25% less than what you're getting from the developer. So they're saying it's interest-free, but is it really interest-free? Then you weigh up the cost of, okay, well, if I took a payment plan from a developer and I get to a certain stage, can I then switch that to a mortgage plan? Is there a built-in? I know that there are some developers at the moment that are saying to people, if you don't take the payment plan, we can give you a discount if you want to pay it up straight away. So then there's an opportunity to get from a mortgage perspective onto a payment plan, which you had with the developer. But if you're looking at taking something, it's probably if you've got it buying off plan, then it makes sense to take developer payment plan. If you're buying ready property in the market, I think you can get better deals buying with a mortgage than with a handover payment plan.
I think you hit the nail on the head. I think you'll pay for it one way or another.
Yeah.
The developers aren't stupid. They'll calculate it into the overall cost of their development. It perhaps helps someone who necessarily can't put down, has enough LTV to put down for the deposit, so they would look then to do it on a post-payment plan. But I think now developers are even now moving the other way. I think we've seen this trend over the last 12 to 15 months of these developers almost acting like banks, and now it's even maybe going the other way where they're saying, well, actually, it's a bit of a risk for us to take on, and banks are now more stepping in and offering more flexible products.
And that's a good thing.
Yeah, it's good.
One of the reasons the market took a tumble in 2009 and 10 was because the banks weren't there, so the developers were acting as the mortgage holders. So I think now that the fact that the banks are more willing to give mortgages, there's more variety, there's more choice in the market is actually a good thing.
Yeah.
It's a sign of the market maturing hopefully over time developers won't need to offer these payment plans to the extent they have been.
I mean, the benefit they do have with the payment plans is if somebody isn't able to get finance for a bank for whatever reason, let's say they've had a shady credit history in the past or whatever, they might have missed some payments or something, it does then enable people to get into something. But the danger of that is it's overcommitting people to get into something, which is because there's no credit checks. We'll give you this payment plan, but there's no checks to see, is it affordable, how's it affordable? So I think that it's kind of got a positive and a negative on both sides of it.
Yeah, I think one of the reasons why a developer went into that post-handover payment plan is that the current LTV by the central bank for off plan is 50%, which is not encouraging investors and people, especially end users who want to invest in real estate property. And that's why the developer came in and tried to offer such product.
Yeah.
Is that
certainly for the off-plan segment, if it's payment plan taking it up to handover, there's a certain amount on handover, it does make sense to take that payment plan. And what I always say to clients is, when you get to a point of when your handover payment is due, it may be that they've got 60% or 70% or 50% on handover. It sometimes makes sense for them to say, okay, well, we're going to squeeze ourselves now to get into this. They might even take a personal loan to get into it. But then when their handover is due, they can take up to 75% on that completed unit. So if they've taken a personal loan to get into it and they squeeze themselves there, it's then a case of spreading that risk, taking 75%, clearing the personal loan, and then making it affordable over the next 15, 20 years or whatever it's going to be, as opposed to 4. So they can work well together, but one against the other, I don't know, they offer two different alternatives. Really.
I think one positive thing that everyone will agree on is that we're pegged to the dollar, and the dollar's been pretty strong for the last 3-4 years, and interest rates have just been cut last week. So I think, from a borrowing side, if you're on a flexible rate product, then you will be making savings. So
Definitely.
Yeah, and a falling interest rate environment is always good for real estate.
Yeah.
So it's good to see that the Fed is taking that move first time in 10 years. So hopefully that will have some positive impacts on the market here.
Great. I mean, let's start taking questions from, we had a lot of questions before we started, and now we're having also live. A question, Craig and Andrew, is it better to invest in apartment or villa? This is a traditional question we always have. If I'm looking for an immediate ROI, and this question is coming from Kelly. So what's your take on this question?
It's horses for courses. It depends what you want. So if you're talking purely as an investment, you're going to get a stronger yield traditionally from an apartment rather than a villa. So if that's your sole driver, what's your rental yield? The answer would typically be apartments will produce a stronger yield. But of course, a lot of people are not buying it purely as an investment, so it comes into whether you want to live in it, whether you want to use it, what's it for. But strictly as an investment, apartments still have a higher rental yield than villas.
I probably don't really have anything to add to it. I think it depends on the person's personal circumstances. What do they have in their existing portfolio? Maybe they already own villas. Maybe they have a family of their own, so if they can't get it rented, they maybe move into a villa. I think there's probably no correct answer to that. As Craig said, though, apartments have traditionally offered a higher yield, but we're now seeing, our data at Cavendish, Maxwell and Property Monitor have shown that Emirates Living community, which is the Meadows and the Springs, have probably dropped about 20 to 24% in the last year alone. So we're now seeing probably a good time to come in and buy these villas, although they do need modernisation.
Maybe a follow-up question on this. We talked about rental yield, but what about capital appreciation? Prices of apartments compared to prices of villas, which one grows faster, which one is expected to grow faster rate, and maybe looking at the capital appreciation side of the yield or the return,
Over time they tend to move together. I mean, you might find one period there's been a bit of an adjustment, so prices have fallen more for apartments and villas, but over a longer term, 5 years or so, that they do tend to move together. So the answer to that question is not a big difference. So go with what you want from your own perspective rather than looking at that. And I think the capital returns, as we discussed earlier, may be getting close to the bottom, and you might be starting to see some growth, and I think that growth will come into both sectors, but perhaps not for the short term.
I think supply and demand, there's probably been a little bit larger supply in recent years of apartments and tower blocks rather than villa communities. So from just an economics perspective, the greater supply, there'll be a downward pressure on capital values, which would mean less capital appreciation. So, I think villas right now, particularly these prime areas, whether it's the Springs or the Meadows or even Arabian Ranches and Victoria Heights, I think they're starting to show very good value, especially in comparison to other markets across the world.
And that's right. Just a ballpark figure: roughly 80% of all the supply, residential supply in Dubai, is in apartments. So only about 20% is in villas. So there are, while there's a lot of new villa projects, that's a relatively small part. It's only about a fifth of the market compared to the apartments.
I want to move a little bit to mortgage. We're talking about investment on mortgage. What is the minimum criteria to apply for a mortgage in the UAE? Do you have to be here for a specific number of years, earning a certain salary? This question is coming from AD Star.
Okay. It's an important question. Now, more than any time recently in the past, I'm getting more people new to market, new to country. They're not thinking about renting. People just want to get in and they want to buy straight away. It depends. There's some banks that will say, okay, you need to be here for a minimum of 3 months. We need 3 months salary into your account. There's some banks that will let it go from day dot. So they'll just say, okay, we'll approve everything, and then 1 month salary hits, and we can let your dispersal happen. Or it may be that they've got continuity of employment coming from a company working in another country, they're transferred to the same company to a division that's over here. Then you can prove that, okay, they've been in the company 6 years, so we can prove continuity of employment. There's obviously some problems that come in if somebody's working in the UK, for example, and their salary is, say, 10,000 dirhams a month, they move over here and the salary is all of a sudden 30,000 dirhams a month. The bank are going to question, okay, there seems to be a bit of irregularity here. How do we combat this? What are the reasons for it? It's not to say that it's not going to happen, but some banks have minimum salary requirements of 10,000 dirhams a month. Some have minimum salary requirements of 20,000 a month. And again, it depends. They may even give you benefit for if it's 30 or 50,000 dirhams a month. You might get special discounts on your rates and stuff. So there's no real restrictions to getting involved in it. It's just you need to tick the boxes with the lender, and there's always going to be a solution for somebody.
Great. Before coming back to Dr. Shahram, a question on LTV. A question coming from Chris Taylor. He's saying that there is a proven correlation between high LTV availability and real estate boom and bust. So why participants in the UAE real estate markets asking for an increase in LTV if that comes at the expense of having a real estate bust, or it impacts the real estate cycle?
Well, the short answer is because it improves liquidity. So obviously, the more you're able to, the higher the LTV, the less down payment you have to put on. The liquidity, more people can afford to buy. But as your viewer quite rightly says, there is a big risk involved with that. So it's actually a good thing, again, for the positive, for the maturity of the market, that those restrictions are in place. I don't think anybody would want to go back to the situation we had in 2006, 2007, where you could borrow 100%. So it's actually, these requirements are a good thing, I think, would be the view of the market.
Yeah, I think you've hit the nail on the head. I don't think anyone's suggesting go back to 100 or 105%, right? It's maybe 85 or 90. They can even tier it, if up to a certain value of property, up to 1 or 2 million, or first-time buyers like they have in the UK, something like that would maybe work well. And I think that's what everyone's sort of voicing.
Yeah, some more flexibility, not just one size fits all solution. If there could be some more flexibility, but nobody wants to go back to 100%.
Sure. Dr. Shahram, on off-plan property, you had a lot of questions. People seems to be a little bit worried about investing in off-plan. What an investor in off-plan market should do before signing booking form, or before even signing the sales and purchase agreement? What they should do as a homework?
Yeah. So off-plan, of course, presents more risk than completed property. Off-plan means property that has not been built yet, but it's being sold. So you can imagine when something's being sold which has not been built, it can be problematic if they don't build what you are promised or what's in the contract. Fortunately, we have laws and regulations to protect the investors. Law 13 of 2008, being the interim real estate registration law, says that your purchase in an off-plan property, even before it's built, will be registered at the land department, so you'll be a registered purchaser, subject to future payments, of course. Also, you can check the due diligence that you must do on off-plan is even probably more important to ensure the reputation of the developer is a good one. Just with anything that you may do in business or investment. Important to check reputation. You can go down to RERA, the land department yourself if you like, or you can have your broker do it. And you can check that the project is registered, that all the documents have been lodged. You can have a look at the plot plans and different things that are registered there for you as an investor. And of course, don't forget that there must be an escrow account, a trust account, set up at the bank such that your money that you pay goes directly into that account, which is controlled by the government for your protection.
What are the common mistakes that investors did before when it comes to off-plan? I mean, common, as a lawyer, you've seen a lot of cases and a lot of issues.
Yes.
Common mistakes.
Well, the problem with off-plan, if I can put it simply, is that it was treated as a speculative tool, almost like an investment in the stock market, where people would invest in off-plan with the expectation that it would go up by a certain percent. I mean, there was a project back in 2008, Al Badra by Angell, which by rumors was going up by 10% per week. So I mean, if anyone doesn't know, that's froth, and I didn't know. But then the problem with off-plan is because it hasn't been built, it tends to be this tradable, like a tradable commodity, like a stock market, which gets thrown around and each person makes a certain percentage until the froth becomes unmanageable. And that's the biggest risk with off-plan. And again, the key is due diligence and to buy something that's proper and well thought out, well priced.
Great. Back to Stuart on mortgage. Two related questions, I think. How can I improve my credit history to get approval for a mortgage? This is by Haley. Linda asked something also, follow-up question. If I'm interested in purchasing multiple properties, how would that impact my mortgage?
Okay. Address the first one. With regards to rectifying your credit history, I mean, the credit bureau now, Al Credit Bureau, relatively new. You can go online, you've got an app, you can download it yourself, and you can find out what your credit history is and your score as well, give you a score. I think anything above 700 is considered quite good. There are problems with some of the information may be misleading, so first of all, check all the information on it is correct, because some of it may not be correct. And then it's a case of having a look at, are your credit cards paid on time? Do you have lots of credit cards outstanding? Are there things that are on your credit file that you didn't even know that was there? And then it's a case of saying, okay, reduce your limits, make sure that you pay your cards, clear them monthly, and all of those will then give you an increase as to how your score will perform after that. Okay, but also clearing any outstanding loans, making sure everything's paid on time. Other than that, you can't really do a great deal to repair your credit history. Now, if we look at the multiple properties on how will that affect your credit score, it's not so much it will affect your credit score, but there are restrictions on the amount of properties that you can have, certainly with any one lender. Central Bank obviously brought in some regulations back in 2014, in January, to say first property is restricted for expats up to 75%, for 5 million purchases and below. Over and above that is 65%, and then for Emiratis you get a 5% extra on top as well. So that's for your first property. Second properties are restricted to 60%. So that is where the biggest hurdle on that I see is if you're looking at multiple properties, or certainly for investment, then you've got it restricted to 60%. So the banks will ask, is it for investment or is it for homestead? So if you're saying it's for investment, some lenders will categorise it as saying, okay, you can only borrow 60%. It doesn't necessarily affect your credit rating. And again, if you've got multiple finances outstanding on your credit file, providing they're maintained and paid, it can actually improve your score.
Great. Can you tell us a little bit more about Ittihad? It's a new initiative by the government. How does that work? Do banks use them before giving you loans?
They do, yeah. And again, I would always say to people prior to going into any application, there's one bank in particular that we frequent quite a lot, and they say to us, okay, we can give you faster approvals if you can get a copy of the credit file. I have an app on my phone. You can literally download the app, Al Credit Bureau. You can ask for a scored report and it can be sent to you within 10 minutes. You can have all the information that the banks will be looking at as well. In fact, banks only see what facilities you have. They don't see what banks it's attributed to. So you'll actually have more information than the banks at that point.
Yeah, it's really impressive, isn't it? If you've not done it, do it. It's I've been here quite a long time, and I was very surprised at the level of detail, going back to all the auto loans I had from 8-9 years ago. But it was also useful because I had a credit card in my name, which I'd never even obtained. So it was useful to get that report before I went to speak to the bank, because I was able then to approach the said company, ask them why they'd issued that card, even though I never had it, and cancel it. And again, looking at your limits, I didn't realise even how high some of my credit card limits were, and whilst I never intend to spend that much, it was useful to bring that down. So from a risk perspective, the banks know how exposed you are and if you're able to afford your mortgage payments.
Mm-hmm. Great. Craig, if I'm buying a new property today, will it lose its value after 5 years because it's going to be old? Or property value depends on the area value? This is a question coming from Wayne Ross.
Of course, it's a critical question, and in Dubai there's always been a bit of a tendency to want new things. So in the past, something that was 5 years old was considered old, and there'd be a discount because it was 5 years old. But I think that's kind of no longer the case now. So in a mature markets, often you find there is a premium for older property. It may have been better built, it may have been, in some markets, it's bigger. And I think that's one of the things you'll find in Dubai now, is that the size of the apartments or the size of the villas has gone down over the years. So you can probably, if you've got something that's 5 years old, yes, you might need to invest in some maintenance, but you've probably got a bigger villa or a bigger apartment than you would if you bought a new one today. So I don't think just because it's 5 years old is a problem. That the market prices will go up and down according to market dynamics, not just because it's an older property. So I think it's more looking at the overall market situation rather than just saying, oh, it's an older property. And personally, I think that there is an opportunity now to invest in second-hand homes, existing homes, rather than off-plan. I think the market has been very caught up with off-plan sales over the last few years. There's been less sales of existing property, and I think probably there are more opportunities that people should be looking at for homes that aren't necessarily brand new, so look for existing homes as well.
Correct, the quality of buildings actually have been raised an issue by a lot of investors. So some even developments, although they're new, 2-3 years old, but they look even older. So what is your recommendation? What should investors do? Should they do an inspection report? Should they look at certain developments, certain developers, or what is the trick?
This all comes back to the issue of due diligence, of course, and it's quite right. There are a lot of developers that the product is. The quality of product varies between developers, clearly. So obviously one of the things that you need to be doing when you're looking at any property is who the developer is, what their track record is. It's not just the quality, but I think we probably want to talk about service charges at some point as well. So the service charges vary a lot between the developers. So look at all these things, look at the quality and look at their track record. I think that's in some ways as important as looking at the product itself. So just making sure.
I think on the older properties, it's not necessarily a bad thing, as Craig said. They have larger plot sizes. Most of these older villas, certainly. I would just say do your due diligence. It's the single biggest investment you make in your life. If you're buying a car, you would probably take it to a garage or check with the service centre. Whether it has an up-to-date record. Do the same with a house. Go and appoint a firm like ours or JLL. You can do a condition survey. You could even go and get a pool company to go and check the pumps in the pool if it's got a swimming pool in the garden. Looking in hindsight, I wish I'd taken my own advice. I ended up having to pay 20,000-30,000 to get the pool fixed. But these are simple things. You could have a company come out and check within an afternoon whether there's any leaks in the pool itself or the lines. And the same goes with the condition of the property. You can have a surveyor like our company come out and walk around and look at the structure of it. Particularly if it's a larger investment, if it's an Emirates Hills villa, I would be certainly doing some of these surveys.
Can I just add to that, just to build a small point? One of the advantages of some of the older properties is location, in my mind. And I realize that the market is still, hasn't fully matured, but as you know, in real estate, location is critical. And the water. So I'll leave it to the experts to talk about that, but I just thought it's a point to bring up.
Yeah, that's actually a good point. And you want to comment, Craig?
No, clearly, as Dubai grows, the travelling distances are getting further. I mean, I think the classic example of that is looking along projects that are along the metro. You mentioned the marina. It's a traditional location, but it's a very good location because you can't get away from the fact it's got the metro and it's got the coastal position. Compare that to some of the newer projects that are now being released in further from the metro, further from the coast. It's a very good point. And while as the market matures, location will it won't be as important as it perhaps has been. It's still obviously a factor you're always going to want to consider.
we'll always come to the location question. I have several questions from live, if we can answer them briefly or fully, but briefly. Question from Roba: what do you think of Arabian Ranches as an area to invest? So this question is common. People will ask us about, this is a question on Arabian Ranches, there is another question on areas close to Expo. So what do you think? Arabian Ranches first and then Expo site?
I think there's always an advantage of looking at an established area rather than a new area. Arabian Ranches is a good example of that. It's already got the infrastructure built, at least for phase 1 and phase 2. So that's better than going further down that same corridor to some of the other projects which are a little bit further away where there is no infrastructure. So yeah, I mean that would be a reason why you would look at an established area like Arabian Ranches compared to Expo. But of course, Dubai South, I should say. But of course, because of that, you're always going to get a price differential. So in some ways, it depends. If you want to more of an uplift in price, you may well be better. You might get that by going to a less established area. Arabian Ranches, you're going to pay more for it because it's an established area, but it's a safer bet. So that would be my general answer to that.
Good. Third question, Stuart, do I need, and this is from Remia, do I need to pay to get a credit report for a mortgage?
Yes, there's different things that you can do to pay. I think the minimum is 80 dirham, or maybe that's the maximum. I can't remember. It's no more than 100 dirhams anyway to get your credit report, and it's done in 10 minutes. So I think it ranges between sort of 50, 60 dirhams up to 100 dirhams.
Yeah.
Some banks will do it on your behalf as well.
Yeah.
I know my bank didn't charge me for it. I just had to provide them a letter granting them consent to apply on my behalf.
Yeah.
Question from Chris: in comparison to previous years, what is the percentage of cash buyers to mortgage buyers in the market? Is there a statistics you can share with us?
We track a lot of that. I mean,
Yeah.
also, I mean, we do a large number of transactions. Every month we're looking at it. I think last month it was about 70%, this month 75%.
Mortgage buyers.
Mortgage buyers, yeah.
So more of mortgage buyers than cash buyers.
From what we're looking at. But we deal purely on the residential sector. So these guys might have some different statistics across other sectors, I'm not sure.
I think on the commercial side, anyway, the asset sizes are a lot larger, so generally they'll take bank financing. Although, having said that, you'd be surprised at the tens of millions that some businesses will happily spend on a property and have no mortgage on it. So I've not really seen a trend.
We analyse the data from the land department, and unfortunately, it's not as clear as you would like. So depending how you cut and dice the data, but I think the point I would make is that cash buyers, investors are still quite a big sector of the market. I'm surprised that 70% are mortgages these days. I would have thought the cash buyers would still be.
Only looking at what we analyse in terms of, but most of ours are end users, not necessarily investors as well. So we don't really see a great number of cash buyers.
Although, because the data from the land department, it doesn't talk about cash buyers, it just talks about mortgages compared to the total, and the mortgages have traditionally been 35-40% of the total. So you don't know whether whether they're cash buyers, whether they're taking payment plans, what they're doing. But mortgages have traditionally been less than half. But there is issues with that data, so I think you're good to rely upon projects that you're working with.
I can talk from a valuation, because we do a lot of mortgage valuations, right? Our volumes have dropped off a little bit over the last 12 months, which would suggest that there's less people either buying or taking mortgages, right? But on the whole, I would say over the last 5 years, it's fairly constant in terms of the number of mortgage valuations. We have seen a slight trend of some of the valuations we're doing are more for refinancing rather than new mortgages themselves.
To get more questions, I know we have a lot of questions here and there, and I'm a bit worried about the timing. So I would like to ask more questions on stuff. How does VAT impact property investment? This is a question from Stephen. Commercial or residential?
Either or. Look, I'm not a VAT expert, but I can tell you that on residential apartments and villas, there's no VAT applicable on the purchase or sale. If it's a commercial property, it depends. If the property is vacant, then the seller should charge VAT and the purchaser should pay VAT. If, however, it has an income stream, so if it's rented out, whether it's a warehouse rented out, or whether it's a retail unit like to Starbucks, then you can purchase it what's called a TOGC, a transfer of going concern, and basically the seller does not charge VAT and the purchaser does not pay VAT. But it has to be rented or partially rented, otherwise VAT would be applicable. And the same applies to the tenancy contract too. So VAT would be chargeable on the rent, and the tenant would pay VAT. Generally speaking though, if you're a VAT elected business, you can reclaim that VAT. So you can pay it and then claim it back from the FTA.
Great. If I want to invest in a ready property and I don't have enough funds for down payment, what are my options? This is from Ahmed Asli.
Okay.
He doesn't have down payment. What's the option?
Doesn't have any down payment. Okay.
Or enough funds for down payment. Let's be.
Okay, so let's assume that you have some towards it. A couple of hurdles that we've seen in the past where banks would suggest a solution. It may be that you're buying the property with your husband or your wife. One is then able to take a personal loan to get the rest of the money towards the down payment, whilst the other one is then taking the mortgage. To take a personal loan from yourself to pay for a mortgage is not allowed under the central bank rules and regulations. But there are some creative ways that banks have been able to get loans to pay for fees or include some fees within the mortgage itself. So there are some banks that are offering up to sort of 79.5%, 80% mortgages, including some of the fees. So you can be as creative as you want with those numbers, but it's kind of a grey area that people will try to find ways around.
Can I share an interesting story with you from 2004? A true story where Nakheel was marketing Jumeirah Islands in 2004 to sell it first from the developer to purchasers. They were offering to cover your mortgage up to 5%. So if your mortgage was up to 5%, Nakheel would pay it for you. If the mortgage rate went above 5%, then you'd have to pay it. And that was an offer that was good, I think, for 5 years. And that's how they were moving Jumeirah Islands back then. So it's an interesting bit of history for us to there's nothing like that in the market now, obviously.
Shahram, a follow-up. Legally, what advice you have to give to investors for the first time? Yeah, he says, or she says, no, he says, yes, and I'm a little bit worried about the payments, mortgage, commitment. What are the legal issues around
mortgages and
yeah.
payment? Well, let's take one step back. I think for anyone who's considering this type of question as a first-time buyer, you have to be comfortable with the purchase that you're doing. You have to be comfortable with the city that you're buying in, look at your job prospects and what your plans are for the medium term and the long term. Based on that, then you can start looking at the property if you're confident in that. And once you do, then it's very important to ensure that your finances are such that you can pay for that mortgage, because there is a mortgage law, and it is like any other mortgage law in other countries. You need to pay your mortgage. If you don't within a certain amount of time, that mortgage can go to court and they could take the property away from you, and that obviously wouldn't be very good for your credit rating otherwise. And so my suggestion is that you be confident in the purchase that you're going to make, just as in any other jurisdiction, any other country in this world. So it's a similar considerations.
What can go wrong? What's the worst case scenario?
The worst case scenario is that you would the person would default on their mortgage. It would then go to court, and there'd be forfeiture. And after some time, that property can be sold to pay off that mortgage.
Is there a jail penalty?
No, there's no
Okay.
jail penalty unless, well, I shouldn't say that. If there have been post-dated checks given for above 200,000 dirhams, it's possible. Generally, jail and real estate were separated back in the crises.
Okay.
Although that kind of came together, and it's been a relationship like this from a legal perspective, from a criminal legal perspective. But hopefully that shouldn't be the case.
I think it's becoming, you advise me a lot better here, but I think it's generally becoming harder to put someone in jail for a bounce
Yes.
check. I think the courts are now taking a bit of a dim view, and we see it in a commercial sense, at least. People struggling to make rental payments, and with the liquidation of businesses and the recent laws there as well.
There's a regulation now which talks about 200,000 dirhams
Yeah.
as a de minimis.
Mm.
So that's why, and hopefully that'll continue such that it's not criminal at all. But unfortunately, it's in the federal law, and changing a federal law is far more difficult than doing things means in Dubai.
I think the other point to add to that is when people are taking out a mortgage, it's important to look at not what the payment is today, but what the payment is going to be in 3 years' time, and that's where people run into difficulty when making their payments. So there are some banks that will still say, okay, we give you 1 year fixed at 2.99, but then it jumps up to like 7% in the following year. That can sometimes double people's payments. That's where people are not being advised properly, and they're certainly not looking into it. So I think one of the key benefits are to see what the rate is following after, and to see what your exit strategy is as well. If you have to sell, how much is it going to cost you? Some banks will charge you 3% now, but if you're looking at a decent lender and you can get out of something, then it may be this 1% or 10,000, whichever is lower. But also do the math. I get people come to me all the time and say, I want a mortgage, but I only want to pay it over 10 years. And I say, okay, what if something went wrong? How do you accommodate for that? So find a product that you can make overpayments with, that can allow you to clear it in 10 years, but make it affordable that if you do run into difficulty, you do lose your job, then it's got to be something where you can rent the property out to cover the payments on the mortgage until such times you're able to sell it.
Is there a mortgage insurance that can also cover in case of losing job or death sometimes?
There's life insurance, which is kind of mandatory with a lot of lenders, but to cover loss of income, you can buy into certain things. I mean, that you need to speak to a financial advisor on buying into different insurances, but as standard bank policies, no banks really offer that because it's very subjective as well. There's a lot of ways out of it.
I have so many questions. Faisal, 2 questions related. How do you see the value of Dubai real estate now in comparison to a few years ago? And I think, this is what he said, supply may be more than demand and driving real estate value down.
Okay. And I want to link this to Expo. I'm sure you've got
there's a question on
about
Expo.
Expo as well. So maybe
3 in 1. So you save time.
So I think we've already answered the first part of that question. Is that prices are probably 25-30% down now on what they were. And a large part of that has been the supply. So I just want to share some quick numbers. Traditionally, over the last 5 or 6 years, the supply of residential in Dubai has grown between 15 and 20,000 units per year, and the market's been able to absorb that. But at the moment, we're seeing a huge increase in that. So this year, if you remember, 15 to 20 is the average. This year, we're seeing about 40,000 plus units being completed, and next year it's about 60,000 plus. So there's a lot of new supply coming on in the next couple of years, and that's largely because a lot of developers are bringing forward projects to get them built before Expo. So Expo's had this huge impact. It's brought forward a lot of the supply that would have happened over a 5-year period and has condensed it into a 2-year period, and that's what's been driving down the prices to some extent. So I think that the good news now is that the boom in supply seems to be tapering off. If you look at the amount of new projects that are being launched, last year there was about 17,000 units launched. This year, year to date, only halfway through, there's only been about 5,000. So the developers are now launching less new product. So I think by 2021, 2022, those big numbers of supply will start to come down, and that's when the market will start to recover. So Expo's having this impact. It's causing a lot of supply in a short period of time. That's pushing prices down. The good news is that after Expo there'll be far fewer projects coming on, and that's when the market could, in our view, starting to recover.
And Andrew, a related question to this, so we can take it. Kamal asked, do you think it's a good option now to buy a property for investment and live in a rental property? Do I make money and profit in this? So you rent out and you buy.
My advice is usually I think before you ever start buying an investment property, you should probably think about buying for your own house to live in first. I think it depends on the circumstances again. If you're here, only going to plan here to be here 2 or 3 years, I don't think you're going to probably see the capital appreciation in that time. So the savings that you might make on rent, you probably won't make up in capital appreciation. So no, but if you're going to be here for 8 to 9, 10 years, and you're looking to live in it, then I think it makes absolute sense to buy for sure. Because the interest rates are still low, your mortgage payments are low, and I think you'll probably be still paying less than you would be in the rental market, even though rents have dropped.
Stuart, a question on how much the percentage of mortgage should be out of my income. This is Hassan asking.
The mortgage payment,
out of the income.
All of your financial borrowings can't exceed more than 50% of your income anyway.
So that includes
personal loans, car loans, credit cards. I mean, again, credit card limits are, again, subjective with different lenders' criteria. Some lenders will look at it and say, okay, we'll take 3% of your total limit. Some will say, we'll take 5% of your total limit. Some may be slightly less or slightly more. But if we're looking at it and saying, okay, let's say, for example, you've got a car loan, 2 credit cards, and a personal loan or something of that nature, the banks will look at it and saying, if your salary is this, 50% of your salary has to fit all of that. If you don't have any borrowings at all at the moment, then obviously you can go a little bit higher, but then you're restricted by the number of multiples, which I think is 7 times your yearly for an expat, 8 times your yearly for an Emirati. You can't exceed that number of your yearly past for a total loan size.
Just to add to that, we kind of take the figure of about 30 to 35% of gross income being what you should pay on your housing. It does vary country to country, but I think as a rule of thumb, if you budget to spend between 30 and 35% of your total household income on accommodation, whether it's rent or sale, that's in line with best practice internationally. And traditionally in the UAE, that figure has been higher. So the average in Dubai has been over 40%. So people have been spending 40% of their family income on accommodation, which is part of the risk. But now as housing has come down, it's become more affordable. You'd want to be looking between 30 and 35% of your total gross family budget.
If I have to choose between Business Bay and Dubai Marina to invest in, what should I look at to compare both?
Again, it's personal. In some respects, personal preference. But if you were, depends if it was residential or commercial. But again, I would look at the sort of supply demand. Both areas are very well established, meaning there's not much land available in both. So you're probably not going to see the oversupply that you would see further out. If it was commercial, I would look at the vacancy. Let's take, if it was an office block, there is fewer offices available in the marina. There's only Marina Plaza and Avatura Tower, whereas in Business Bay there is a lot more commercial offices. So you're probably prone to a higher vacancy and more competition. Perhaps on the retail side, though, you could say the opposite. There's more retail availability in the marina, whereas there's less in Business Bay. So it really depends on the circumstances of the particular investor and what asset class they're looking, whether it's hotels, residences, or commercial.
Mm-hmm. Stuart, questions from Wael. Does the pre-qualification for a mortgage means that I'm 100% eligible, or I may face some challenges?
Again, it's subjective to which lender. There are some lenders given approval in principle, which is basically look at this is what you earn, this is what you do, and they'll give you a limit based on that, but without doing any kind of tests against your stress testing or anything with your credit file. There are some lenders that will do all of their due diligence at the point of saying, okay, well, here's everything, so we're literally approving you for everything now. All we then need to do is add in the property documents. But then there may be a credit check later on down the line as well. So there could be 2 or 3 credit checks throughout that whole procedure. And especially if you've got approval that lasts for maybe 45 days or 60 days, if that lapses, then you need to go through that procedure again. So it's not an open shut for every lender. Every lender's got different policies and how they look at it.
Ali Sabri asked, can a mortgage property be sold?
Yes, of course. And again, what you need to think about is what's outstanding on your mortgage. So if you're selling your mortgage, if you're selling your property is worth 3 million dirhams, you've got 2.5 outstanding, it's quite straightforward. So and if the person's buying refinance as well, then you'll find a way to structure the whole deal. If it's the fact that your mortgage is more than what you've got outstanding that you're selling it for, then that's when you find that yourself running into a few issues. And we've had a lot of these lately where people have been in the market for quite some time, they bought at the height, and there are some banks that are looking at it sensibly and saying, okay, you've paid it for this long, we've had this much money from you, we kind of want this asset off our books. So there may be situations where banks are saying, okay, you've got 2.5 on the table, 2.7 is outstanding, we'll let you off the 200,000. I'm not saying it happens in every deal, but it's something worth exploring with your lender. But simply speaking, yes, you can. All you then do is you would release the mortgage at the land department right before you go to do the transfer, so there'd be a mortgage release fee that needs to be paid at the land department, which I believe is about 1,600 dirhams. And then you've got, is it an Islamic mortgage or is it conventional mortgage? Again, the situation's the same. So,
in terms of mortgage for off-plan properties, Ronan asking, is there a certain procedure for mortgage of off-plan?
I mean, off-plan mortgages, I would simply look at what the payment plan is being offered by the developer first. Because a lot of it is 50, 60, 70% on handover, which means you wouldn't need an off-plan mortgage because off-plan mortgage is restricted to 50%. Mm-hmm. So if you restrict it to 50%, the likelihood is nothing's going to come into play until it's ready for handover, and then you're stuck with a high interest rate because it's off-plan lending, which is a high risk. So I'd explore all the other avenues first before looking at off-plan lending. Some cases there maybe it's 25% to be paid on handover. So I would say to clients, rather than take off-plan financing, why don't you look at taking a personal loan to take care of the 25% or whatever's going to be up to that point? Pay what you can, and then whatever's difference, pay, and then take a residential mortgage at the point when it's ready for handover. Way more affordable, a lot more variety in the market as well, and you're not restricted to off-plan rates you're going to get stuck into for the next 20, 25 years.
Dr. Shahram, if Hugo is asking, if I want to resell an off-plan property, do I need to get government approval?
To resell off-plan property, well, you have to get government approval in the sense that off-plan property is registered at the government, it's registered at the land department in Okud. And so that's good for you because you are registered and you have a document and electronic registration knowing that you're the owner. And therefore, when you want to do that, you have to go to the government, pay a fee, and get that transfer made, as well as you need an NOC and no objection certificate from the developer. So those are the two primary approvals that are needed. Of course, if there's a mortgage involved, you need bank approval.
As a first-time investor, Ima is asking, is it better to invest in off-plan or ready? That's also a common question.
I've personally done both, and again, didn't do my due diligence back in the day in 2006, fell into a bit of a trap, but in saying that I also bought off-plan through EMAR and have done very well. I've also bought ready properties in the Greens and done very well. I've just bought another property now which is ready for handover direct from the developer. So I think if you look at it in terms of personal, I've kind of won with all of them, so I didn't really lose out and stuff, but I think if you look at it as from a investment perspective, then
I think it just depends on your circumstances, right? And your risk profile. Traditionally, buying off plan is riskier. But if you're comfortable with it and you feel that there's more upside to it, then it could work well for you.
And the developer.
And the developer.
The reputation of the developer.
I think gone are the days in the boom market you would actually pay more for off-plan than you would for existing, which is a nonsense because clearly there is an extra risk, therefore the off-plan should be cheaper than the existing. But now, so I think gone are those days. So that's you can factor it in. So if we're assuming off-plan is cheaper than existing, then that's the trade-off. You could be getting something for a lower price. But you have to take the risk that you're not quite sure what it's.
I would say if it was for an investment, you're not getting really a rental return on that property until it's completed. So if you're wanting it for income and a yield, you should probably buy a ready property because you can rent it immediately.
We have 5 minutes, so I'll ask a question. If you can answer in 10 seconds. Are there separate mortgage rules for expats and GCC nationals? I think you answered that.
Expats and GCC nationals, no, they're very much the same. It's more Emiratis have slightly more in terms of the general it's 75%, whereas it's 80% for Emiratis, below 5 million. So GCCs fall under the same category as expats.
If me and my friend are buying a property, how does the mortgage work? Can it be under two names?
Very restrictive again. If it's you and your friend, as in male, then sometimes you can buy together, but there's very few lenders that will do it. And because it would be an investment property, it would be restricted to 60%.
Very good. How is Sharia mortgage different from non-Sharia? That's a question coming from Michelle.
Principally, they work in the same aspect. It's just obviously it has to comply with Sharia rules, whereas conventional mortgages have been around for forever and a day. So it's just a case of how it's handled. One, you don't necessarily own the property until you've paid off the debt. And the other one, you will own the property with the bank having a lien against it. So you will essentially be paying rent to the bank until you've paid enough rent that they can give you the property back.
Which is the Sharia.
Which is the Sharia, yeah. But in terms of the ownership, you're free to sell and do whatever you want with the property, unless it's any upgrades, then obviously you need to speak to the lender on both occasions.
Any saving, any cost difference between both?
No.
So in terms of money, it's almost the same.
Everything, for me, I don't really see any benefit from one or the other. It's just whatever works for people. There are still maybe some restrictions on some Sharia lenders will say, okay, your payments are fixed, whereas the interest rate may necessarily not be. So you could fall into a point where there's a balloon payment to be made at some point in the future. That's the only downside that I see.
Dr. Shahram, in terms of residency visa and investment, what are the laws on that?
So we've seen a tremendous movement on residency visa and real estate investment, as well as other areas in this country and in this jurisdiction in Dubai. So when it comes to real estate specifically, there's the residence visa of 3 years, which has been around and been offered for a property worth $1 million or over, and that's been around for a while. But what's new is that we have new visa regulations for a 5 million dirham investment and a 5-year visa, and potentially more as we go forward. So this is part of a package of residency visa offerings that the country and Dubai is offering to attract foreign direct investment, attract people who are here working to invest in property. So watch that space. I think there's much more to come, and it's very good news for the market as well as for people who want to invest here.
What's the difference between freehold and leasehold? This is a question as well.
Yes, that's a question for the ages, freehold and leasehold. And if I can add a question that we discussed just before, is freehold really freehold? I'll just address that because I do know that people have that question. So let me start with that myth first. Is freehold freehold, or is it what I'm buying, the government come and take it from me tomorrow? Well, no, it doesn't work that way. Freehold is fee simple, which exists in the United Kingdom, which exists in the United States and Australia and New Zealand and in continental Europe. Full ownership of property. You own that property. Of course, if there's oil underground at 4 kilometers, it's not yours. But that's the same in the UK and elsewhere. It belongs to the Queen, and here it belongs to the government. So it is the same principle. Freehold is freehold. Once you get your title deed, you own it. So that's very assuring.
It's an ownership into perpetuity, basically. You own it forever. And a question I get a lot is, people say freehold means international ownership. That's not necessarily the case. It means you own it into perpetuity because you get both local freehold and international freehold.
And then freehold and leasehold. Well, leasehold, as you know from other jurisdictions as well, is just renting it for a longer time. Whether I rent it for 1 month, 6 months, 12 years, 90 years, 99 years, or 999 years, it is leasehold. It just depends on the duration. That is leasehold. Whereas freehold means you own it forever. You own it in perpetuity.
So I think for leasehold, if it's over 10 years, you have to register it with the DLD, and you pay your 4% transfer fee. If it's under 10 years, it's treated as an Ajara.
Great, which is 118 something. Well, I have 1 minute, and I want to give everyone 30 seconds of that 1 minute. I don't know how that works, but what's the expectations? What do we see as we're approaching Expo 2020? Optimistic, pessimistic?
I'll start from a lawyer's perspective, which means that I don't have any expertise on the numbers. So it's my own personal opinion, for whatever that's worth. I'm very optimistic about Expo 2020. I have to tell you that. The reason I say that is because I've lived through an Expo before. I was a child. Expo came when I was in grade 12 in another country in Canada, and it transformed that city from a backwater city to an international city, a jewel on the Pacific. And really that transformation was related to attracting foreigners who understood now what that city is about. And that foreign investment then built that city. It became that incredible city that it is now. And I'm talking about Vancouver. I see the same thing here. I think it's going to be marketing, but I think this is going to be something even greater. So I'm quite optimistic.
Great.
As I mentioned earlier, I think the negative side of Expo is it's caused a lot of new development over the last few years. So the supply glut we see at the moment is partly due to people wanting to get things built for Expo. I think 2020 will be the bottom, and that the market will recover again after that. And usually, normally with Vancouver and with other Expos, the market is usually peaking around that time, and then it goes down after the Expo. This time, the Expos come at the bottom of the market, so I think that will be the turning point. And I think given the supply numbers I was talking about earlier, people have less new projects coming in 21 and 22, I think that 2020 will be the bottom of the market cycle.
I think everyone needs to remember real estate is not a short-term investment, so whether you think it's the bottom or not, it shouldn't really matter. But if you are buying, I think it's a fantastic time to be buying or renting. I would just say do your due diligence, do your homework on who the developer is, do your homework on banks and mortgages, speak to the right advisors, and seek professional help.
So, okay, exactly that. I've literally just bought again now because the optimism that I have in this market, I think, is that things will become a lot better. But as Andrew was saying, just do your due diligence. Make sure that if there's something that you want to buy, but is not necessarily affordable at some point in the future because of whatever risks that you're taking, just make sure that it can be affordable in terms of renting. You know, don't be in a position where you're forced to have to sell. You know, you'll only ever lose money if you have to sell. So if you can find yourself in a situation where it is a long-term prospect, then I think those are the things that you need to go into, you know, kind of intelligently.
Thank you so much. Ladies and gentlemen, thank you so much for your engagement, for your questions. And we're too sorry if we missed any of these questions or we couldn't answer them. We'll be answering them offline. Thank you so much, and looking forward to have you and your engagement for next time. Our focus will be on service charge, owners association, your favorite topic. So thank you so much, and thank you experts for being with us today.
Thank you.
Thank you.
Thank you so much, Bayut team. Thank you everyone. Thank you.